There are moments when a system reveals itself not through noise, but through absence. Not through headlines, but through silence. Not through chaos, but through something quietly missing. In the spring of 2024, nearly 37.6 million ounces of silver vanished from the US commodities system in less than 2 months. No announcement, no emergency press conference, no clear explanation that matched the scale of what had just occurred. And most people never noticed. That alone should make you uncomfortable. Because silver is not a fringe asset. It is not a speculative toy. It is not a collector's curiosity. Silver is infrastructure. It sits inside smartphones, solar panels, medical equipment, military hardware, electric vehicles, data centers, and nearly every modern technology that defines American life. If oil is the blood of the industrial economy, silver is its nervous system. So when tens of millions of ounces disappear in a matter of weeks, the question is not, will prices go up? The real question is far more unsettling. What kind of system allows something this critical to drain so quickly without forcing an honest conversation? Before we go any further, let's reset expectations. This is not a story about hype. This is not about price predictions. This is not financial advice dressed up as urgency. This is a story about structure. About how the American commodities system actually works. About how paper claims replaced physical reality. And about what happens when too many people ask for the same thing at the same time. If you stay until the end, you will not walk away feeling panicked. You will walk away clear. And clarity is far more dangerous to fragile systems than fear. Now let's start with the event itself. Between late March and early May, official data showed that registered silver inventories connected to US futures markets dropped by approximately 37.6 million ounces. That is not retail demand. That is not coin collectors. That is not a TikTok trend. That is institutional metal. Silver that was previously available for delivery against futures contracts. Silver that existed to back promises. And then, suddenly, it didn't. To understand why this matters, you need to understand how the silver market is supposed to function, at least on paper. In theory, futures markets exist to allow producers and consumers to hedge price risk. A mining company locks in a price. An industrial buyer secures supply. Speculators provide liquidity. In theory, physical metal sits quietly in vaults, waiting to be delivered if needed. In theory. In practice, the modern silver market is dominated by paper claims. For every ounce of silver that physically exists in approved vaults, there are often dozens, sometimes hundreds, of paper contracts referencing that same ounce. This system works beautifully, until it doesn't, because it assumes something critical, that most people will never ask for delivery. They will roll contracts. They will cash settle. They will treat silver as a number, not a substance. For decades, that assumption held, until demand stopped behaving politely. To see why silver is uniquely vulnerable, we have to go back, not to 2024, but to America's monetary past. For most of US history, silver was not an investment. It was money. From the Coinage Act of 1792 through the 19th century, silver and gold coexisted as the backbone of the American monetary system. Dollars were weights, not abstractions. Trust was anchored to metal, not policy. That changed gradually, and then suddenly. In 1873, the US effectively demonetized silver. Historians later called it the crime of 1873. Not because it was illegal, but because it shifted monetary power away from tangible constraints and toward centralized discretion. Silver didn't disappear, but its role changed. It became industrial. And that distinction matters. Gold is hoarded. Silver is consumed. Every solar panel uses it. Every electric contact relies on it. Every technological leap quietly increases demand. And unlike gold, most silver is never recovered. It ends up dispersed, recycled imperfectly, or lost entirely. This makes silver structurally different from almost every other precious metal. Supply is finite. Demand is cumulative. Consumption is permanent. Now layer on top of this the modern financial system. After 1971, when the US fully severed the dollar from gold, markets entered a new era. Money became elastic, debt became foundational, and commodities became financialized. Silver stopped being something you used. It became something you traded. This shift created efficiency and fragility. Because once a commodity becomes primarily a financial instrument, the system optimizes for liquidity, not resilience. Paper silver exploded. Exchange-traded products, futures contracts, derivatives layered on derivatives. All of them promised exposure. Very few promised delivery. For decades this worked because demand for physical silver remained relatively stable. Then the world changed. Energy transitioned. Electronics exploded. Defense requirements increased. Supply chains fractured. And suddenly, physical silver mattered again. But the system had forgotten how to treat it as physical. Now we return to the present. When 37.6 million ounces leave registered inventories, it means one thing. Someone wanted the metal. Not exposure, not settlement, not a price. The metal. This is where the story becomes uncomfortable. Because when physical silver leaves the system, it doesn't just vanish. It goes somewhere. It moves into private vaults, into industrial stockpiles, into sovereign reserves, into places where it is no longer available to back paper promises. And when that happens, leverage increases. Every remaining ounce supports more claims. The system becomes thinner, more efficient, more profitable, more fragile. This is not manipulation in the cartoonish sense. It is structural stress. And stress always reveals truth. Here is what makes this moment different from previous drawdowns. This did not happen during a price spike. It did not happen during panic buying. It happened quietly, which suggests planning, not emotion. Large players do not move tens of millions of ounces impulsively. They act when incentives align. So what changed? The answer is not one thing. It is a convergence. Rising industrial demand, geopolitical uncertainty, a growing distrust of paper settlement, and a futures market that quietly encouraged leverage for decades. When confidence weakens even slightly, rational actors reduce counterparty risk. They stop trusting promises. They ask for delivery. And the moment enough people do that at once, the system faces a dilemma: deliver metal or change the rules. Historically, markets choose survival over purity. This is why silver matters. Not because it will go to the moon, but because it exposes the fault lines between abstraction and reality, between numbers and atoms, between what is promised and what actually exists. In the next part, we will examine how the silver market became so leveraged, why this is not an accident, and why the US has seen this pattern before, often right before major monetary transitions. To understand why the silver market behaves the way it does today, you have to let go of a comforting illusion. The illusion that markets are designed for stability. They are not. They are designed for throughput. For decades, the American commodities system optimized for one overriding goal: efficiency of trading, not security of supply. Speed mattered more than redundancy. Liquidity mattered more than resilience. Silver became a victim of that success. As futures markets expanded, they transformed the metal from a physical necessity into a financial abstraction. Contracts multiplied. Leverage increased. The distance between ownership on paper and ownership in reality widened. At the heart of this system sits the futures exchange, an institution that most people assume exists to ensure fairness and transparency. In reality, its primary function is coordination. It coordinates expectations, prices, and risk transfer. But coordination only works when participants broadly agree on one assumption: that delivery is rare. Futures markets are not warehouses. They are confidence engines. When that confidence erodes, the system is forced to reveal how little metal actually stands behind how many promises. This is where silver becomes uniquely revealing. Unlike oil, silver cannot be produced on demand. Unlike fiat currency, it cannot be created with policy. Unlike gold, it is not stored predominantly for monetary insurance. Silver is used up. Every year, more silver is consumed than is recovered. For decades, this imbalance was masked by above-ground inventories, government stockpiles, strategic reserves, and private hoards accumulated during earlier eras. Those buffers are now largely gone. What remains is a market running on just-in-time metal. This is not speculation. This is documented history. In the mid-20th century, the United States held billions of ounces of silver. It was embedded in coinage, strategic reserves, and industrial stockpile. By the late 1960s, those reserves were depleted. The Coinage Act of 1965 removed silver from circulating US coins, not because silver was no longer useful, but because it had become too valuable to waste as currency. This was a warning, a signal that physical silver mattered more than the system was willing to admit. Yet instead of rebuilding reserves, the financial world did the opposite. It leaned harder into paper. Silver futures expanded. Derivatives proliferated. Exchange-traded products promised exposure without possession. From the perspective of Wall Street, this was rational. Physical metal is slow, paper is fast, and speed wins in modern finance. But speed comes with a cost. When leverage increases faster than supply, the system becomes dependent on behavior rather than reality. As long as most participants treat silver as a trade, not a resource, everything works. The moment that changes, the system tightens. This is precisely what we are witnessing now. The disappearance of tens of millions of ounces is not the cause of stress. It is the symptom. The deeper issue lies in the ratio between paper claims and physical availability. Publicly available data has long shown that the amount of silver represented by futures contracts far exceeds the amount of silver that can actually be delivered. This is not hidden. It is not illegal. It is structural. The assumption has always been that not everyone will ask for the same thing at the same time. History shows how fragile that assumption is. In 1980, when the Hunt brothers attempted to corner the silver market, the system responded not by delivering metal, but by changing the rules. Margin requirements were raised, position limits were enforced selectively, liquidation-only orders were imposed. The market survived, but the lesson was clear. When physical demand threatens paper stability, paper is protected. This is not a conspiracy. It is institutional self-preservation. Markets are designed to survive. What is different today is scale. The silver market is now embedded in global supply chains. Solar energy depends on it. Electrification depends on it. Defense systems depend on it. This is not retail speculation. This is industrial necessity. When industrial users begin to treat silver as something to secure rather than something to source later, behavior changes. They do not roll contracts. They do not accept cash settlement. They remove metal from circulation. This creates a feedback loop. As inventories decline, risk increases. As risk increases, more participants seek security. As more participants seek security, inventories decline further. This is how shortages form, not through panic, but through rational decision-making. Now consider the role of large financial institutions. For decades, a small number of banks have dominated silver trading. They act as market makers, clearing agents, and liquidity providers. Their role is not to hoard metal, it is to facilitate flow. This works as long as metal moves. When it stops moving, the system strains. Settlements related to silver market practices in the past have already revealed one important truth. Prices can be influenced through structure without anyone needing to coordinate in secret. When a market is thin, leveraged, and centralized, outcomes follow incentives naturally. No villain is required. Just math. This is why the sudden drawdown of registered silver inventories matters so much. Registered metal is not decoration. It is the portion explicitly available for delivery. When it declines rapidly, the margin for error disappears. At that point, the system has only three options: increase supply, reduce demand, or discourage delivery. Supply cannot be increased quickly. Mining projects take years. Recycling is limited. Above-ground reserves are finite. Reducing demand is politically and economically costly. That leaves the third option: adjusting incentives, higher margins, cash settlements, rule changes that quietly nudge participants away from physical claims. These mechanisms are not dramatic. They are procedural, and they rarely make headlines. This is why most people remain unaware that anything unusual is happening. The system is doing what it was designed to do: absorb stress quietly. But quiet absorption does not eliminate risk. It concentrates it. Silver, in this context, becomes a signal, not of collapse, but of transition. Historically, when physical commodities begin to diverge sharply from their paper representations, it precedes broader monetary realignments. This happened in the late 1960s with gold. It happened in the 1970s with inflation. It happened in various forms during energy crises. The pattern is consistent. Physical reality eventually asserts itself, not explosively, gradually, relentlessly. In the next part, we will look at who is likely taking delivery, why this matters for the United States specifically, and how silver fits into a much larger story about trust, currency, and the limits of abstraction. When physical silver leaves the system, the most important question is not how much disappeared. It is who needed it badly enough to take it out. Because taking delivery is not the default behavior in modern markets. It is expensive. It is inconvenient. It creates storage, security, and logistical obligations. In other words, it is something you do only when exposure is no longer enough. This is where the narrative shifts from mechanics to intent. Retail investors do not remove tens of millions of ounces from registered inventories. Coin dealers do not have that reach. Even hedge funds rarely bother with physical delivery unless something fundamental has changed. The actors capable of moving silver at this scale fall into three broad categories: industrial consumers, sovereign-linked entities, and institutions reducing counterparty risk. Each tells us something different, and together they tell us a great deal. Let's start with industry. Silver is not optional in modern manufacturing. There is no true substitute with comparable conductivity, reliability, and versatility. Every solar panel requires silver paste. Every advanced circuit relies on silver contacts. Every modern vehicle contains more silver than its predecessor. The energy transition did not reduce material dependency. It intensified it. And unlike software, metals do not scale gracefully. As demand increases, supply does not follow automatically. It resists. It lags. It fractures. Industrial buyers understand this. They do not care about spot prices in isolation. They care about availability. A factory does not shut down because silver is expensive. It shuts down because silver is unavailable. So when procurement teams observe declining inventories, longer delivery times, or increasing volatility in settlement terms, they act defensively. They secure supply. Not next quarter, not next year. Now. That means pulling metal forward. And once that metal is off market, it rarely returns. The second category is more opaque. Sovereign-linked entities do not announce their intention. They do not publish procurement strategies. They move quietly, through intermediaries, over time. Historically, states pay attention to commodities when trust in financial abstractions weakens. This does not require panic, only prudence. A nation does not need to predict collapse to diversify its reserves. It only needs to recognize that systems built on confidence are vulnerable to shifts in sentiment. Silver has always occupied an ambiguous position in this context. It is too industrial to be purely monetary, too monetary to be purely industrial. That ambiguity makes it useful. It can be justified as a strategic material while still serving as a store of value. When silver leaves visible inventories without fanfare, it often suggests this kind of quiet reallocation. Not accumulation for speculation, accumulation for insurance. The third category may be the most telling. Institutions reducing counterparty risk. In a world where leverage has become normalized, risk is not eliminated. It is displaced. Futures markets allow exposure without ownership. That is their appeal. But exposure comes with dependency. You depend on clearinghouses, on counterparties, on rules remaining unchanged. Most of the time, this is acceptable. During periods of structural stress, it becomes uncomfortable. Institutions that have lived through previous crises understand this instinctively. They remember what happened when markets closed, when settlements were delayed, when rules changed overnight. They remember that liquidity disappears precisely when it is most needed. For such actors, physical possession is not ideology. It is risk management, and risk management rarely makes headlines. Now zoom out. Why does this matter specifically for the United States? Because the US dollar sits at the center of the global financial system. That position brings privilege. It also brings responsibility. The dollar's strength is not derived solely from economic output. It is sustained by trust in markets, in settlement, in the reliability of American institutions. Commodities play a quiet but crucial role in that trust. When commodities are plentiful, priced transparently, and delivered reliably, the system feels stable. When physical commodities begin to detach from paper representations, questions emerge. Not immediately, gradually. The United States has seen this before. In the late 1960s, gold outflows from US reserves accelerated as foreign governments quietly exchanged dollars for metal. There was no panic. There was no collapse. There was recognition. Recognition that the promise embedded in the system no longer matched reality. By the time the public noticed, the decision had already been made. Convertibility ended. A new era began. Silver today is not gold in 1971, but it rhymes. It reveals tension between promise and provision, between abstraction and material constraint, between speed and substance. This is why silver shortages matter, even if prices appear subdued. Price is not the only signal. Availability is often more honest. Markets can suppress price through structure. They cannot conjure atoms. At some point, something has to give. That something is rarely dramatic. It is procedural. Delivery terms adjust. Premiums rise off exchange. Industrial users sign longer contracts. Physical markets decouple quietly. By the time retail investors notice, the metal is already gone. This brings us to a crucial misconception. Many assume that if silver were truly scarce, prices would already reflect it. This assumes a free market. The modern silver market is not free in that sense. It is intermediated. Price discovery occurs primarily through paper trading, not physical exchange. As long as confidence in paper settlement remains high, price can lag reality. But confidence is not binary. It erodes, and erosion accelerates once it becomes visible. This is why the disappearance of registered silver inventories is so significant. It is a visible crack, not large enough to cause panic, large enough to prompt questions. And questions are dangerous to systems built on assumption. In the next and final part, we will confront what this means going forward, not as a prediction, but as a structural analysis. What options remain for the system? What risks are being quietly transferred? And what this moment reveals about the future of commodities, currency, and trust. There is a tendency, when confronted with complex systems under stress, to look for a single breaking point, a moment, a headline, a collapse dramatic enough to feel conclusive. But systems like the silver market rarely fail that way. They transition, quietly, procedurally, incrementally. And by the time the public senses that something has changed, the change has already occurred. This is the nature of structural risk. It does not announce itself. It reallocates itself. The disappearance of tens of millions of ounces of silver is not a prediction of catastrophe. It is a revelation of preference. It tells us what rational actors are choosing to do when given the option. They are choosing possession over promise, security over efficiency, reality over representation. This does not mean panic. It means repricing of trust. Every financial system is built on layers of trust. Trust in institutions, trust in settlement, trust that what is promised can be delivered if required. As long as trust remains high, leverage is invisible. When trust weakens, leverage becomes visible and uncomfortable. Silver sits precisely at that fault line. It is not the most glamorous metal. It does not dominate headlines. It does not carry the mythology of gold, which is exactly why it is so revealing. Silver is honest. It is required, not admired. Consumed, not hoarded. Embedded in function, not symbolism. When silver leaves the system, it does so because someone needs it to work, not to impress, not to speculate, to function. That distinction matters. Now consider the choices available to the system from here. They are limited. Physical supply cannot be increased quickly. Mining timelines are measured in years, not quarters. Recycling recovers only a fraction of what is consumed. Strategic stockpiles, where they still exist, are politically sensitive and finite. Demand is not easily reduced. Technological dependence on silver is increasing, not decreasing. Energy infrastructure, electrification, medical technology, and defense applications are structural priorities. That leaves adjustment. Adjustment of rules, adjustment of incentives, adjustment of expectations. We have seen this playbook before. Higher margin requirements, more cash settlement, subtle discouragement of delivery, greater reliance on over-the-counter markets. None of these are shocking. All of them are rational from an institutional perspective. They preserve continuity, but they do something else as well. They move risk. Risk does not disappear. It migrates. From exchanges to private contracts. From transparent inventories to opaque agreements. From public visibility to private negotiation. This is how systems remain outwardly stable while becoming internally more brittle. It is not malicious. It is mechanical. The silver market is not broken. It is exposed. exposed to the limits of abstraction, exposed to the consequences of decades of leverage, exposed to the reality that some things cannot be scaled infinitely. This exposure is not unique to silver. It is a preview of how physical constraints reassert themselves in a world that has grown accustomed to digital liquidity and financial engineering. The lesson here is not that silver will run out. It is that availability and price are not the same thing. Markets can manage price. They cannot negotiate with physics. At some point, delivery matters more than valuation. At some point, possession matters more than exposure. That point is not announced. It is inferred. Which brings us to the most important realization of all. This story is not about silver. Silver is the messenger. The message is about how modern systems handle stress. They do not fail loudly. They adapt quietly. They preserve form while altering substance. This is why intelligent observers do not wait for confirmation from headlines. They watch behavior. They watch inventory levels. They watch settlement terms. They watch what large, rational actors do when no one is watching. And right now, those actors are reducing dependence on paper claims for physical necessities. That does not mean collapse. It means recalibration. The United States has navigated such recalibrations before, sometimes smoothly, sometimes painfully. Never without consequence. The outcome is rarely what the public debates at the time. It is shaped instead by decisions made quietly, early, by those who understand incentives and constraints. This is why understanding matters more than prediction. Predictions satisfy ego. Understanding preserves agency. If you have followed this analysis to the end, you are not meant to feel alarmed. You are meant to feel oriented. Oriented to how systems behave under pressure. Oriented to the difference between signal and noise. Oriented to the fact that scarcity is often revealed before it is priced. That orientation is rare, and it is valuable. Because the greatest risk in complex systems is not volatility. It is complacency. Complacency is what allows assumptions to harden into blind spots. Silver's quiet exit from registered inventories is not a warning siren. It is a reminder. A reminder that physical reality eventually asserts itself, not dramatically, but decisively. If this perspective helped you see the system a little more clearly, not through fear, not through hype, but through structure, then it has done its job. If you value this kind of long-form, evidence-based analysis in a world optimized for speed and outrage, you can support it thoughtfully. A subscription helps this work continue. A like signals that depth still matters. And if there is one person you trust enough to have a serious conversation with, someone who prefers understanding over headlines, share this with them. Ideas like these are not meant to spread loudly. They are meant to spread carefully. And if you choose to leave a comment, make it one that adds to the conversation. A question, a reflection, or a challenge grounded in thought. That is the highest form of appreciation for work like this. Thank you for staying until the end.